Hello and welcome to this video. In this video, I'm going to share how to calculate your net profit and your return on investment for your buy-to-let property investment. So what we need to do to work out what our return on investment is and our net profit, we need to work out how much money we are using to buy our investment property. If you like my video or any of my videos, hit the like button below and subscribe to my channel for more of this video. Let's get to it. So let's assume that we've bought this property for £100,000. £100,000 property, you could get them anywhere from the north of England or from the northeast or South Wales or the north of Wales. You can get properties that can generate you absolutely amazing cash flow and with a positive return on investment. So let's have a look at this example where we've assumed we bought a property for £100,000. So if we bought a property for £100,000, we would require to pay 25% of the £100,000 to the bank who is borrowing that money to us, the bank who is lending that money to us for us to be able to buy the property, okay? So we will need to put down £25,000. So, and also if we're buying a property in the UK, we will need to pay our legal cost, which is the solicitor fees. This solicitor fee is what you pay for your solicitors to do the research for you to ensure you're buying a good property and the actual owner is the actual owner of the property. And obviously we have stamp duty. This is a tax. This is a tax you pay to the government for buying that property. And it's usually 3% if you're buying your second property, okay? So 3% of the 100,000 plus the solicitor fee is roughly about £3,450. So if you put £3,450 here, that would be for our legal cost and our stamp duty. And also if we're buying a property, we would need to value the property to ensure that that property that the seller is asking us to buy 100,000 is actually worth 100,000. So we don't want to buy a property that is worth 80,000 for 100,000. Hence the reason why we're going to instruct our surveyor to go and value that property. And it usually costs us about £400. So we put the £400 against that. And then obviously because we're buying a property on a buy-to-let mortgage, we need to find a mortgage broker who would go out in the market and find us the best mortgage that is suitable for the property we are buying for. They will look for the best interest rate, they will look for the best mortgage lender, they will look for all the important things that matches the property you are buying for. And we usually pay them about £350. Right? And then obviously because we are buying a property to do as a buy-to-let, we don't normally buy properties that has already been completed and works have already been done. We normally buy properties that we could go in and add our own feel to it, which may be minor refurbishment that we need to do to actually uplift the property a little bit to ensure that it is attractive to the sort of targeted market for our property. That is usually about £5,000 to do the refurbishment work. Let's assume £5,000, okay? So that's the £5,000 we pay to ensure that the property is in a good standard or is in a good lettable standard that we'll be able to let to our tenant. So if you add all this amount up, say 25,000 plus 3,450 plus £400 plus £350 plus £5,000, that will give us £34,200. £34,200. So £34,200 is our initial investment for this property. So we need to have this money to allow us to buy this property that is worth £100,000. So this is the amount of money we would require to pay. That goes to your solicitors, and then the solicitor pays that money to the bank. This is a reassurance to the bank to know that you are financially worthy to borrow 75% of the £100,000. And obviously the part of the stamp duty would go to the government, the legal fees will go to the solicitors. Obviously you pay your valuation fees to the surveyor, and you've got your mortgage cost, which you pay for your mortgage broker to ensure you get to the best mortgage. And then we've got the refurbishment, which is what you use to actually do up the property to ensure that it is lettable. So all those amounts sum up to the 34,200. So this is how you calculate your initial investment. So now let's move on how to calculate our net profit for this sort of property deal. Okay, let's work out our net profit. So we're going to assume for our £100,000 property investment, we're going to attract a tenant paying us £650 per month for renting our property out. So because we want to work out what our return on investment is, we need to multiply our rental income by 12 months as well as our expenses by 12 months to give us the annual net profit. So if we assume that our rental income is £650, if we times that by 12 months, that would give us £7,800. The £7,800 is the amount of money we receive from renting our property out to a tenant. Okay, this is the value we have added because basically we have actually provided an accommodation for someone to live in with their family, and they're paying us handsomely £7,800 a month. Okay, so we also got the expense. The expenses are what enables us to keep the property as it is now and let it out to the potential tenant or to our tenant. So now we will be paying a mortgage interest. The mortgage interest we're paying is for the 75% the bank borrowed us to be able to buy the properties. If you remember, we put down 25% of the 100,000, which was £25,000, and the bank lent us 75%, which was the £75,000. Altogether sum up to £100,000, which allowed us to buy the property. So we'll be paying interest on the 75,000. So I normally assume 3%. So let's assume 3% for a year. That will be £2,250. Okay, and then fees, because we are going to be instructing a management agent to look after our property, we would have to pay them a fee. So that fee includes them managing the property for us, advertising it, any repair and maintenance required, they will let us know. So this then makes our property be a passive income investment, which means we don't need to actually get involved to actually renting the property, managing it, repair and maintenance. Then the agent will look after it for us. So you usually pay the agent 10% of our gross rental income. So that would be £780. £780 is what we're going to pay for the agent to manage our property. And we have insurance. It is mandatory for each and every landlord or property owner to insure their property. So we'd have to pay the insurance and any other costs. So I like to put other costs just in case we have repair and maintenance to do, or maybe there's some little thing that we've missed out during our refurb that we've not completed. So we will use that money to actually do those work. So I normally put in about, say, £624 a year. So £624 a year, that's what we're gonna pay for our insurance, and put some of that money aside should we need to do any maintenance work in our investment property. So if we subtract £2,250, £780, £624, that would give us a net profit of £4,146. £4,146. So this is our net profit. This is the amount we've generated for renting the property out to our tenants. So this is the benefit we had from buying that property and renting it out. So this is our net profit. Some people call it net cash flow, but I like to call it net profit because this is the actual real amount you've actually gain from renting the property out. So now let's work out what the return on investment is. But what I like to do first is for you to understand what is the definition of return on investment. Some people call it ROI. The return on investment is the benefit investor will receive in relation to their investment, in relation to the £34,000 200 we've invested to buy in this property. So how much benefit we've gained from making that investment. So that's what the ROI is. The higher the ratio, the greater the benefit of our investment. So let's get to calculating the ROI. Okay, so what's the formula of ROI? ROI is net profit divided by our initial investment. So basically, it's the gross rental income minus all your expenses, which gives us the net profit. We divide that net profit by our investment, by the amount of money we've invested in that property. So our formula would be net profit divided by our initial investment. So what this says is £4,146 divided by our initial investment, which is £34,200. So if we divide 4,000 by 34,000, so if we divide £4,146 by 34,200 times 100, that would give us our return on investment. So our return on investment, if you divide these two figures up, is 12%. So 12% is our return on investment for this property deal. So if you remember, the higher the ratio, the better, and the higher return on your investment. So we always have to look at this to ensure that we're getting the absolute best on our property investment. So this is how you work out your net profit, your return on investment, to ensure that this deal works for you and is making you money and it is passive. Okay, if you've liked my video, hit the like button below and subscribe to my channel for more of this video. I look forward to sharing more videos. Thank you.